Welcome to Beavers Wealth Management's June 2025 edition of Let's Talk Markets. Our goal remains clear: to educate, inform, and empower the families and businesses we serve. And so, if you find today's discussion valuable, please feel free to share it with those who might benefit. And let's get straight to it today. We got a lot of fun stuff to cover. And so, first, I want to kind of look back at May and do a recap and a synopsis of what we saw. And so, let's start with the market performance since the sharp downturn we experienced back on April 7th. And one fact clearly stands out: big tech is still carrying the load. So looking at this chart, you can see the impressive growth in the market capitalization of the S&P 500. Since that April low, the index has added, are you ready for this, roughly $7.5 trillion in total market value. A significant recovery, obviously, by any measure. But here's what's fascinating. When you take a deeper look, over half of that gain, around $4 trillion, has come from just a small group of companies, commonly referred to, as we've talked about, the Magnificent Seven. So let's put this into clear perspective. This small group alone has driven 9.1 percentage points out of the total 16.8% return of the entire index during this stretch. Within this select group, certain companies have especially soared. Tesla, it's up an incredible 53%, while Nvidia has surged over 42%. The takeaway from this chart is unmistakably clear. Without big tech, we simply don't have this market rally that we've seen since the beginning of April. So it also highlights not only the powerful influence of few dominant companies, but also underscores the importance of understanding where market strength truly lies during periods of recovery. And so let's kind of zoom out and take a look at where the markets currently stand. And so I found this really interesting. If you take a look at the top three sectors of the S&P 500, industrials leads the way, 8.6% for the year. Utilities, 8.3%. Communication services, 6.1%. Here's the interesting part. You want to know the bottom three sectors? Consumer discretionary, healthcare, you ready for this? Information technology. Now, granted, still up 1.3%, but I think it goes back to the fact that a few names are really representing that particular index and that particular sector. And so what I thought would be interesting to do is look at a little bit more of kind of this idea of where markets are seeing their return. And I'll tell you, if you look at where we stand today on a couple more facts, the Fed funds target rate, about 4.5%. There was a meeting today, and I'll go into a little bit more detail about that, but they kept interest rates, the Fed kept interest rates the same, didn't change. Not to be, we're not surprised by this, but 4.5% is where it is. Inflation, 2.8%, and unemployment at 4.2%. All right, now this is a really, really good fact today. So Ryan's market fact, as we typically do each Let's Talk Markets, today's fact is titled Debunking the Sell in May Myth. So every year like clockwork, we always hear the same thing. You'll hear this phrase, sell in May and go away. It's catchy, sure, but is it actually good advice? The answer is not really. This saying tends to resurface as headline clickbait right around spring, and it stokes fear and second guessing among investors. But if you actually look at the data, which is what we do here at Beavers Wealth Management, the story just doesn't hold up. While it's true that May through October tends to be seasonably weaker than the November-April stretch, the S&P 500 still posts positive returns during this period, more often than not. Actually, up 72% of the time, with an average annualized rate of return, 6.6%. And if you followed that advice this year, you missed out, right? The S&P 500 gained 6.3% in May alone. It's actually the best May performance that we've seen since 1990. So what's the takeaway from this? timing the market based on old sayings or seasonal trends rarely works out in your favor. If you're a long-term investor, every month is a good month to invest. Ignore the calendar-driven headlines and stick to your plan. Long-term discipline wins every time. All right, let's talk about everybody's favorite topic this time, tariff situation and an inflation update, okay? And so over the past few months, we've talked a lot about tariffs, what they mean for markets, and how they might unfold. But today, we want to look at something a little more specific. How do tariffs actually impact inflation? And in turn, what does that mean for your portfolio? At the end of the day, the biggest implication tariffs have on markets comes down to this core question. Do tariffs raise costs for consumers or businesses? And by the way we assess that, at least in part, is we've got to look at the inflation data. So now that we're into June, we're finally starting to see the first inflation data that could reflect any consequences from the early April tariff announcements. All right, so let's break that down. Before we even get to the numbers, it's important to understand what's actually inside the inflation figure we reference so often, right? Because we say CPI or Consumer Price Index. What are we talking about? We're actually talking about a weighted basket of goods and services purchased by consumers. But not all categories carry the same weight. This is why I like this chart. Take a look at this. It actually shows the components of CPI and how much each one matters in the final number. What you're going to see here is, oh my gosh, look, housing makes up nearly 45% of CPI. Transportation and food and beverages together make up the other 30%. And then the remaining categories, medical care, apparel, recreation, and more, they round out the rest. And so when inflation runs hot, it's not necessarily because all prices are rising evenly, right? It usually means one or two big categories like housing or energy. They're the ones that are doing the heavy lifting. So let's take a look at the latest CPI data for May. Here's what we found interesting. Despite concern that tariffs might drive prices higher, the May CPI report showed no significant spike. Headline inflation came in at 2.4% year over year, which was just a slight uptick from April. Core inflation, which excludes volatile food and energy prices, it remained flat for the third straight month at 2.8%. One of the biggest takeaways from this, shelter, that includes rent and homeowner equivalent rent, was once again the most stubborn contributor, rising 3.6% year over year. And since housing carries such a large weight in CPI, like we saw from the graph before, that alone keeps inflation readings elevated. So in fact, if you remove shelter from the equation, inflation would have been at or below the Fed's 2% target in 20 of the last 24 months. Now, meanwhile, other categories, we actually have seen price declines. Gasoline prices, they've dropped 12% year over year. New vehicles and apparel also declined in May. And so far, the costs of newly imposed tariffs haven't meaningfully trickled down to the consumer yet. Now, President Trump has continued to push for a rate cut, but markets, they're just not buying it yet, right? The Fed is staying cautious. And according to the CME FedWatch tool, markets priced in virtually no chance of a rate cut today in the FOMC meeting, and that's exactly what we saw, no rate cut, and only a 19% chance of a small cut next month. So what's the takeaway for investors? Tariffs are still a headline risk, no doubt, but their inflation impact hasn't really materialized yet. At least for now, inflation remains stable. The Fed remains patient, and markets continue to monitor shelter costs as the biggest swing factor in CPI. Now, We'll continue to watch how these developments unfold, especially if further trade measures are announced. But as always, we remain focused on the long-term fundamentals and not overreacting to short-term noise. All right, let's talk about something a little bit more fun. And I'm going to start this segment called Welcome to Y'all Street. There's a new buzzword around financial circle these days, and it's called Y'all Street. That's right, not Wall Street, it's Y'all Street. Texas is stepping into the financial spotlight, and the centerpiece of this story is the new Texas Stock Exchange. We've talked a little bit about this on previous Let's Talk Markets. It's the TXSE. But now, with multiple exchanges now connected to Texas, I wanted to clear up some confusion first, because I imagine a lot of y'all didn't know this. Earlier this year, the New York Stock Exchange, the NYSE, which we all know, relocated its regulatory operations from Chicago to Dallas, establishing NYSE Texas. However, this move primarily involves shifting administrative and regulatory functions without creating a truly separate exchange. NYSE Texas operates under the established umbrella of Intercontinental Exchange, utilizing existing infrastructure and regulations. Now, in contrast, the Texas Stock Exchange, TXSE, represents a completely fresh initiative. And the TXSE is what we want to focus on today, right? It's backed by an impressive $161 million from financial giants like BlackRock and Citadel Securities. TXSE is building a brand new national securities exchange from the ground up. It's actually going to officially be announced, and it was announced in early 2025, but it's going to launch trading next year in early 2026, with listings becoming available by year end. Now, as of now, the TXSE is in the regulatory approval process, and so it filed its official registration in January 2025, and as I said, expects to begin trading operations in early 2026. So the question we have, why Texas? Why now? Simply put, Texas has grown into the second largest economy in the U.S. Largest economy in the U.S., many of you probably know, California. What's interesting is it's the 8th largest economy globally. So I had to go back and look at this, right? Because I thought to myself, all right, how many countries are out there? There's 195 countries in the world. And Texas, if it was its own country, ranks 8 out of 195. So it's in the top 4% if it were its own country. So with hundreds of companies that are relocating here to Texas, driven by favorable tax conditions, business-friendly policies, and robust economic growth, Texas has become fertile ground for a new kind of exchange, one that specifically targets local companies looking for a streamlined path to going public. And unlike traditional exchanges, TXSE plans to implement notably stricter listing standards, potentially excluding about 1,700 companies currently listed on the NYSE and the NASDAQ. This unique approach prioritizes quality and local relevance, aiming to attract companies who see significant value in being associated with Texas' vibrant economy and distinctive business culture. The implications of TXSE are significant, right? For investors, it means fresh opportunities to invest directly in Texas's thriving economy. And for companies, it provides an accessible route to public markets without navigating the broader and sometimes burdensome requirements of national exchanges. So long-term, TXSE could shift financial gravity towards Texas, transforming the state into a genuine financial powerhouse. Ultimately, Y'all Street isn't just about a catchy nickname, even though it is a really good nickname. It's a serious effort to reshape how regional financial markets operate. All right, so whether your interests lie in supporting Texas companies or seeking regional growth opportunities or simply staying ahead of new financial developments, the TXSE is a story definitely worth watching closely, and we will be. We'll continue monitoring this and updating you on major milestones, new listings, and the broader impact on Texas and beyond. Okay, now I wanted to end with this because I think that there's some fun little tidbits here that y'all might find interesting. And so I'm going to go through and talk about the top 30 stocks in 30 years. And I'm not going to talk about all of them, but I want to highlight a few things. Since we're on the topic of stocks, let's wrap this thing up with what's the most fun. And I want you to take a look at this chart. All right, so this chart shows the top 30 performing stocks in the S&P 500 over the last 30 years, from June 1995 to May 2025. Now, if someone asked you to guess which stock topped the list, don't look yet, odds are you probably would say a tech name. Maybe Apple, Amazon, or Nvidia, right? You ready for the kicker? Monster Beverage holds the #1 spot. That's right. The energy drink company turned a $10,000 investment. How much do you think it went to? $44 million. Not Amazon, not Nvidia, Monster drinks. I'd love to know how many people actually watching this have actually tried a Monster drink, right? Of course, big tech, it's still well represented, as we can see. Amazon and Nvidia, they both posted total returns north of 270,000%, right? This is good. And names like Netflix, Apple, even Tesla, they made the cut. But here's where it gets kind of interesting. When you break the list down, you start to see a few themes emerge. Here's what we found. Number one, tech is dominant, but it's not alone. About a third of the top 30 companies are in tech or tech-adjacent sectors, meaning semiconductors, software, IT services. It's a powerful driver, but it's not the whole story. Consumer brands, they actually shine. Companies like Costco, I know I couldn't live without Costco, Ross, O'Reilly Auto, Tractor Supply. They show that retail and recognizable brands have delivered massive long-term returns. Also, healthcare's quiet strength, right? 6 companies on this list fall under biotech or healthcare. Names like ResMed, Intuitive Surgical, and IDX Labs. They're not always flashy, but they're incredibly consistent. The other thing is boring businesses can be the most dependable. Distributors, trucking companies, even land managers like Texas Pacific Land Corp all prove that you don't need headlines to generate serious returns. The other thing, IPO timing matters, no doubt, but time in the market matters more. Tesla didn't go public until 2010, and it still made the top 30 with an annualized return of over 43%. But compounding works fast when the underlying business is strong. The other part of this is diversification works, right? The companies span a wide range of industries, as you can see. And the takeaway isn't about picking the next monster beverage. It's about staying broadly invested and letting time do the heavy lifting. Because the point here isn't about predicting winners perfectly, right? Nobody's going to be able to do that. But it's about having the discipline to invest in quality businesses and the patience to just let them run. Because sometimes the best performing stocks, they're the ones that no one saw coming. And that's exactly why we stay diversified and stay invested over time. Now, as we've seen recently, market volatility can create significant uncertainty. And the people you care about may be feeling unsettled about their financial future. If you have a friend, family member, or colleague who could benefit from a trusted second set of eyes on their investments, now is the perfect time to introduce them to our Second Opinion service. I know I've said this before, but we created this service so that anyone could come to us with their current investments or their financial plan or their strategy and just kind of gain a fresh perspective, ensuring that their investments align with their unique goals and provide their reassurance that they're on the right track, right? And so If someone you know could benefit from this clarity, we really encourage you to reach out to us anytime. We'd be honored to help. So we are so grateful you joined us today, and we encourage you to share this content with anyone who might find it valuable. And I know I've said this before, but we have the replays of all of our Let's Talk Markets posted on our new YouTube page. And then the video podcast format is also on Spotify. And thank you for the emails that we've gotten here recently. But YouTube and Spotify are also home to our episodes of our podcast Between the Bears and the Bulls. And we've been releasing new episodes every month. And so I say this and I'll say it again. If you have suggestions on what you'd like to see from us, let us know, right? We want to make sure that the content we put out there is valuable to each and every one of you. And so I hope that y'all have enjoyed that podcast over the course of the last 6 months. Oh, okay. And one last thing before you go. With the 4th of July just around the corner, I've been catching up on a little American history. And I came across this fascinating little historical tidbit. Do you know what the most popular dance was back in 1776? The Independence Dance. We'll see you next month for July's edition of Let's Talk Markets. And don't forget, leave it to Beavers.